Larry, always such an enormous pleasure to see you.
Likewise.
Thank you. This is the Deal Time podcast, so a little bit different.
Okay.
So why don't you kick off? Please introduce yourself, name, company name, and position, and then we'll talk about the company.
Sure. My name is Larry Feldman, and the company's name is Feldman Equities. I am the CEO, and we are an office building owner and developer.
Tell me the story of your company. What's the background to Feldman?
Sure. The company goes all the way back to the 1920s to my grandfather. My grandfather and my father were both general contractors and built heavy construction type projects all around the country. Things like airports and exciting projects like sewage treatment plants. They built missile facilities for the U.S. government, for the military, and then morphed in the 1970s and 60s. They morphed to become a developer where they built things only for their own account as opposed to fee construction for third parties. And then I joined the company in the 80s and became the CEO in the 90s. We specialized in that period of time and all the way through today's date in office buildings primarily, although I have done some retail. My main focus throughout most of my career, and my dad before me, is office buildings. And now Mac, as you know, Adam, is fourth generation.
Yeah, it's absolutely wonderful. I love that. Now, you ran a REIT, didn't you? There was a REIT story in the 90s.
I did, yeah. In around 1997, we took the company public. We renamed the company at that time Tower Realty Trust. We were traded on the New York Stock Exchange under the symbol TOW, and I was the chairman and CEO. We were public for about 2.5, 3 years, and then we merged into what is now, there was an interim company in the middle, but most of our buildings that we owned and or developed in Manhattan and Florida were acquired by what is today SL Green. And then following that merger, it was sort of like a neutron bomb. The buildings survived, but the people didn't, something like that. But we reincarnated as a privately held company and bought back from the public company a series of buildings that included Florida properties, and then sort of reincarnated as a primarily Florida-based company. That was around the year 2000, and ever since then, we have been buying aggressively throughout Florida. We've had an emphasis in Tampa. Our sister company has bought a lot in Orlando, where we owned when we were public, and then owned as well as private. And also we've owned and managed in Southern Florida as well.
And what is your investment philosophy? Like, what's what do you look for?
Sure. Well, going back to those old general contracting days, we look for properties that are in A locations. We want to buy the absolute best location we can buy. And we want to buy buildings that have decent bones so that when we get done renovating them, our total dollars in to the cost of renovating winds up at a level where we can still make money post-renovation. So we bring in all of that old background of heavy construction that goes all the way back to my family's beginning. We're not afraid to spend as much as $20 million on a building to completely renovate it end to end. We don't just come in with a paintbrush and a little lobby refresh. We'll in many cases redo every surface of the building that you can see visibly. And we'll put in things like brand new fitness centers, business centers and conference centers for tennis, chill zones where you hang out with laptops on soft seating and with a cappuccino machine 24/7, and play zones for millennials. All these types of amenities are geared to driving occupancy. So we'll buy a building that physically needs improvement in an A location. We'll come in with a massive renovation, which will include these kinds of amenities that I just talked about, fitness centers, conference centers. We'll put in new restaurants with healthy choices and those sorts of things. And all of that is designed to drive up occupancy. So a typical building we'll buy is only maybe 80% leased, 70% leased. And we're going to use our renovation to drive up occupancy and drive up cash flow, which eventually leads to a much higher valuation, so that 3 to 5 years after we work our magic, we can exit either through a refinancing or a sale and realize the fruits of our labor.
And you have a name, don't you, for those renovations? You've got to share that.
Yes, our lobbies, we refer to, when we do a lobby, we completely gut the lobby typically to where a casual observer walking into our lobbies post renovation will swear that this is a brand new building. We refer to that medical procedure as a lobbyectomy. With respect to the whole building, and usually we'll renovate the whole building, that medical procedure is a radical officectomy.
I love those terms.
Thank you.
So here we are. We are emerging from a once in 100-year pandemic,
Right?
An earth-shattering event.
Right.
Talk to me about the future of office buildings as an asset class, but also as an investment opportunity.
Right. Well, as you know, Adam, back in March of last year, the stock market was falling about 2,000 points a day. And there was a belief that we were basically looking at the end of the office building, that the office building would go the way of the buggy whip or the dinosaur, and that tenants would not pay rent. And it was basically Larry Feldman cuddled up in the fetal position in March of 2020. Then as time progressed, we actually collected rent. In fact, all through 2020 and into 2021, after an initial pause, we are now back up to pre-pandemic rent collection, which is about 95 to 97%, which, by the way, is the same number that all of the public REITs that own Class A buildings, they're all reporting similar rent collection. And then a funny thing happened, and I think I told you about this. My head of leasing, who sits right here, you can't see it in the screen, but she's right here. She's the best leasing lady in Tampa, maybe in the state of Florida. And would come in and say, Larry, I've got a lease. And I said, what, a new lease? She says, yeah, please, I need you to sign it. And I was like in shock, because I was reading such horrible negativity that I couldn't believe we actually signed a new lease. And then that would happen maybe once every few weeks. And then it turned out to be once a week, and then twice a week. And then that happened all through 2020, and it's accelerating now in the first quarter of 2021. We've added up our same store sales. That ignores any buildings we acquired. We acquired a building in 2020. So you take that out. Our same store sales is actually up for new leasing year over year. So go figure.
That's interesting.
We do think it's mainly the Florida effect, but it's also our renovations, which have really outdone our competitors. Our intense marketing program, which is unique in the industry. We pay our real estate brokers a higher commission. We pay them faster. We do a lot of things that are focused on driving up occupancy. And like the old newscaster, Tim Russert, I don't know if you remember that name, is a great old newscaster. at every election, he would say, Florida, Florida, Florida. That's really a lot of our wind is at our back with being in the state of Florida.
And you're seeing also, oh, sorry about that. You're also seeing this idea that people are working from home, but you're also seeing more space per person as well. Talk to me about that a little bit.
Yeah, I call it WTF, WFH. WFH, work from home is going to shortly, and many CEOs are saying WFO, work from office. That is really becoming more and more the mantra. It's so funny that a survey was done by KPMG, leading accounting firm, right? And the heat of COVID, roughly, I'm going to say July or August of last year, survey said 70% of CEOs intended to cut back on their office space footprint post-COVID. The exact same survey, the exact same company, KPMG, came out with their report just now, and guess what it says? 17% of those CEOs expect to cut back on footprint. So what is this all about? So here is a little bit of flavor. People are saying now, oh, the new vogue is going to be the hybrid. Have you heard about that, the hybrid yet?
What is that?
The hybrid is we're going to let people work from home 2 days a week. And so we're going to have some sense of company culture and cohesiveness. We're going to have people in the office 3 days a week, and we're going to do what we call hot desking. There'll be nobody who'll have their own office. You'll plug and play as you come in. You won't know what office you get assigned until somebody at the front desk says, go to desk number 39 at the end of the corridor.
Right.
And so that may wind up cutting office footprints down by 30, 40%. But on the other hand, if you think about what happened since 2008 to 2019, was exactly the worst thing that could have happened to the industry, which was every year office using companies, service companies, put more and more people into less and less space, so much so that it became a petri dish for COVID. So now they realize they've got to spread people out further. So where 2 days a week might be as much as a 30, 40% headcount reduction of space need, you have counteracting that a 30 to 40% spacing of desks. So those two things may just kind of wash each other out. And then you have companies that are just saying, we want everybody back in the office, period. And the number one company that has announced that is Amazon. And I'm going to almost quote them verbatim. We are an office-centric company. We want everybody back in the office in person so that they can work together and collaborate and create and best serve our customers. That was just issued worldwide as a statement by Amazon. Today, Jamie Dimon says he's canceling all Zoom calls. He's at it with Zoom. And Zoom stock has started to tank, which is a wonderful thing. And I apologize to any of your viewers that might work for Zoom. But, we've been taking a verbal abuse from friends and family, all year long. Well, who needs an office if you have Zoom? Well, and I know, if you spend enough time on Zoom, you feel like Tom Hanks in that movie Castaway, where he starts screaming at his volleyball, Wilson. It's just the whole idea of working from home is very isolating. In my personal case, my closest friends wouldn't come to see us. We sequestered at home for a few months. I think you and I were on a Peloton bike. That was like
that's right.
That was my socialization during that period. We had a little tiny video screen on the Peloton screen.
That was crazy, wasn't it?
It was just, it was just, and I felt like I was kind of slightly losing my mind a little bit. By the way, I'm very healthy and sane normally, but I just felt like Tom Hanks in that movie, Castaway. And it's so interesting. You know, the reason I mentioned that movie is it's interesting. He had all the food and shelter that he needed. Remember in the movie?
That's right, I do.
But he was still losing it. Even though he was surviving, he was not surviving. So human interaction, face to face, in person, to me is almost like a basic survival.
All right, so let's wrap up this sponsor profile. Sure. I'm interested in knowing you're not a fix and flipper. You don't do deals every week. You're very deliberate when you find deals. Talk to me about the opportunities that you see and how you look for them and what kind of frequency you think, because I know that when they do come for you, they come and they go quickly for investors. So what do you look for and why does it take so long to find a good deal?
Our key metric is, can we buy the bricks on a price per square foot that lead us to a calculation whereby post-renovation, acquisition price plus all of the cost to renovate, we are still way below the cost of building a brand new building. We get very excited about that. If we're buying a Class A building where we can bring it up to an A+ by renovating it, if it's in a great location, we get very excited about those economics, particularly in markets like Florida, where we have enormous growth, where there will be new construction, which is typically $400 to $450 per square foot, as compared to our total renovation costs of somewhere around $250 per square foot. We love that discount, and it makes no sense for us to build right now, even though we're happy to build from the ground up and have built the office buildings from the ground up. We don't see the logic of doing that. And we get very excited about buying bricks much cheaper than they cost to build. So that goes all the way back to my dad and my grandfather and that old general contracting day background and my own background as a developer where I have built from the ground up. And I know what it costs to build. So those are the kind of the key simple metrics that we look at. And then, we want to make sure that the market has demand drivers. So we look for first a state like Florida, and then we look for specific markets within the state where there is tremendous in-migration of companies and residents and also youth. Even though I'm an older guy at this point, I still believe in youth and the energy that creates. So we look for places where maybe traditionally there was an older resident base, but now there's a large influx of new, vibrant tech companies, which are augmenting the traditional insurance, banking, and other finance-related companies in the law. Those are the traditional office users that I grew up with, but now, I get really excited with the Googles and the Apples and those type of companies.
Larry, let me ask you one final question and then
Sure.
I'll ask you to sign off. Last question. What's been the hardest lesson you've learned in real estate that informs how you work today?
I have lived through several recessions. One of the recessions was I opened a 40-story tower in Midtown Manhattan, and I felt like I was in a 747 in a nosedive, where I could see the label of a golf ball on the golf course. It was pretty scary times, and I remember, the survival mechanisms I used, which were, intense marketing. That's something that got us through those recessions. But I'm always afraid of the next recession. A lot of developers are always saying things like, well, we can speculate. Let's just not take that tenant. We'll we'll wait to get a higher rent. Just tell them, no, I'm not going to lease that's rent. We're always undercutting our competitors and filling up space faster and keeping our rents up for the renewal period of the lease. So we're always thinking about the next recession, and it goes back to those old survival days where I remember when demand was weaker. So when demand is good, we take it, and when demand is weak, we take more market share. And those are the things that, aside from that and my prostate keeping me up at night, that I think about.
But this is a family show, Larry. What All right, one last question. So you will remember the days of radio when you had to tune in to listen to a show.
Right.
So, just thinking in those terms, this is a podcast, so you start it when you want to and you listen to the whole thing. But if somebody were to tune in and only hear your last sentence or two, what would you want them to take away from this podcast?
In one or two sentences.
You can spend as much time as you like. I'll put another reel on the recorder.
Well, I think you are, if you invest with us, you're dealing with a company that has survived multiple recessions. And the philosophy I just talked about is a sort of a rent and repent, was an old refrain of my dad's, which was, we don't try to get the last stretch up to the last rent dollar. Our whole methodology is fill our buildings, keep them well occupied, driving up cash flow by driving up occupancy, using our creative renovations to do that, and incredible amounts of marketing. We outmarket our whole competition, and I think that's what's gotten us through multiple recessions, and probably will get us through the next one. So I think that's what's unique about our company, the fact that we are also innovators, and we like to use the slogan, we're reinventors of the office buildings. We're one of the first developers to put in a fitness center in an office building back like 30 years ago. Now we're doing these fitness centers that you wouldn't believe. They look like something you'd pay $100 a month to be a member of, with the most beautiful machines in the world, full shower facilities, big gyms, which we give for free to our tenants. All of that is designed to attract new tenants and retain existing and drive up net operating income.
Larry Feldman Equities, just an enormous pleasure to see you again. Thanks so much for being on the podcast today.
Thank you very much. Yeah.
Hello there, Adam Gower here, and welcome to the GowerCrowd Podcast, the real estate crowdfunding show Deal Time, where you can learn about active crowdfunded real estate deals directly from the sponsors themselves. Subscribe to my free weekly newsletter at GowerCrowd.com, where you'll get links to the podcast, as well as news and updates exclusively from the world of real estate crowdfunding. Sign up at GowerCrowd.com so you don't miss out. Also, if you want to pitch your deal on the show, just go to the podcast page at GowerCrowd.com and look for links on how to submit your deal. Please note that while I don't endorse the deal, sell securities, or make investment recommendations of any kind, some sponsors are GowerCrowd clients. Now listen in and learn about the next great deal on the GowerCrowd Deal Time podcast. Here we go. Larry Feldman, Feldman Equities. What a pleasure to see you. Just do me a favor, introduce yourself, please. And then I'm going to ask you about Pinnacle Corporate Park. I'm dying to talk to you about this deal.
Very good. My name is Larry Feldman, and the company's name is Feldman Equities. I am the CEO, and we are owners and developers of office buildings based in Tampa, Florida.
And you have a deal in Fort Lauderdale, Pinnacle Corporate Park. Tell me about it, high level. What have you got there?
Sure. Fort Lauderdale is in the epicenter of the charge of the Light Brigade of exodus from the Northeast into Florida. The Pinnacle Corporate Park, which is a 2-building office complex, is located almost immediately off of Interstate 95, just north of downtown Fort Lauderdale. The property is almost equidistant from Miami to the south and West Palm to the north. So it's almost the perfect location if you want a Southern Florida epicenter. This is kind of like where you would put the dot on the map. And there are many companies, in fact, that we've met in the buildings now. The buildings are about 83% leased. Almost every interview of every tenant we interviewed almost all the tenants. They tell us that's why they are located here. It's in the exact epicenter of Southern Florida to service the whole Southern Florida market. And Southern Florida is right now the largest metro area, the Miami-Broward Metropolitan Statistical Area. That's what the U.S. government calls the greater Miami metro area. That is the #1 job producer consistently in the state of Florida. Florida is consistently ranked as the #1, 2, or 3 state in America for job production, depending on the given month. So what we're seeing here is a massive exodus from the Northeast into Southern Florida. The area is quickly becoming known as Wall Street South. Guys like David Tepper, making $1 billion a year, by the way, living in the state of New Jersey, has recently relocated himself down to the state of Florida. He, by the way, left $150 million hole in the New Jersey state budget.
Isn't that incredible?
We have no state income tax here in Florida. So in 2017, the tax laws changed, and the deductibility of state and local taxes basically ended in New York and New Jersey and other high tax states. So if you relocate to Florida, it's like for a guy like David Tepper, it's literally like he makes another $150 million a year just by living here. So we've had a whole sea change of movement into Southern Florida, where you used to hear about South Americans buying every condo in Miami. To some extent, there's a little bit of truth to that now, but it's actually flip-flop almost 180 degrees to where all the buyers now, virtually all, are actually domestic buyers. And instead of 85-year-olds, it's more like 55-year-old hedge fund billionaires that are moving down and bringing their companies with them. So this is the epicenter location. We have, in this particular project, a huge competitive advantage in that it's a very high-end suburb. The buildings are Class A, but the price point of rental rate is cheaper than the downtown West Palm, downtown Fort Lauderdale, and downtown Miami rental rates, which are going up as high as $70 a square foot on a gross basis in some of those downtowns. We're at about $35 a foot gross. So it's an ideal location to service the whole Southern Florida, to bring employees from all over and clients and it's at a price that's affordable.
Right. So let's talk about numbers on this project. First, let's talk about the building itself. So the square footage, tenant diversity, WALT, just to demonstrate how much I know about offices these days, current vacancy, etc.
Sure. Building's about 260,000 square feet. It's a two-building complex, 260,000 square feet. The average lease term remaining is over 4 years. The tenancy ranges from companies like Transamerica to US Bank. There is a company called Vertiv, which is a publicly traded $8 billion company that is contracting right now with Citrix. Citrix world headquarters. This is a multi-billion-dollar tech company. Not a household name, Citrix necessarily, but in the tech world, they're very, very big and well-known. They are literally headquartered 2 blocks away, and Vertiv, our largest tenant, is their major contractor. So this is actually becoming a hub, not just for Wall Street firms, with the nickname Wall Street South, but it's also a well-established tech hub. You know, IBM has had a presence down in Southern Florida going back all the way back to the beginning of the PC in early 80s. In fact, there was a great story of Bill Gates trying to pitch IBM for a thing called Outlook, right. For a thing called Outlook or whatever. Yeah. That was down here in Southern Florida. So there's a lot of talent pool for tech and a lot of growth in tech in our area. So,
and I know that you see some opportunity in this building, obviously, because that's what you do. So tell me about the value add strategy that you're planning to do here. What's the opportunity?
Yeah, you know, there are probably about 20 some odd buildings in this immediate suburban submarket just north of downtown Fort Lauderdale. And this is considered one of the top 2 or 3 buildings of that group of, say, 20 buildings. We want to move it and elevate it to become number 1. It already is in terms of the way it looks. It's got a very Class A look versus its competitors, but it is lacking what we refer to as tenant amenities. So item number 1, you've heard it now from me before, we're going to put in a first-class fitness center, the kind of fitness center that you would pay $50 to $100 a month to be a member of, which we will basically give for free to our tenants. We will be putting in a boardroom and a business center, again, which we'll be providing to our tenants for free. By the way, that works very well with a small tenant. Let's say he's only a 2,000-foot tenant. He doesn't have to build the 100-year flood conference room. So where he might otherwise have to lease 2,500 feet, we say, go ahead and lease 2,000 feet, only pay rent on 2,000 feet, and get our conference center for free for your 100-year flood meeting. It gives us a great competitive advantage.
That's interesting.
Yeah. Then for the younger folks in the building, and I'm not age discriminating, but I can because I'm older. The younger folks can avail themselves of these play zones where we'll have the shuffleboard, the beanbag throws, cappuccino machine, soft seating, hangout areas in the building. Then we'll have a cafe with very healthy choices that's going to be very high on the priority list. So all of these renovations are going to be about $2.7 million per our budget, and will, in our view, take our occupancy up from 82 to 83, up to about 93, 95, and over time drive up the rental rate. We expect that to take our net operating income up from $3.7 million at acquisition up to about $5.5 million 4 to 5 years out. When we get to that much higher income, we will have created a much higher valuation for the building, which we think can result in significant capital appreciation. And along the way, we'll be able to pay about a 7.5% average dividend, going in about a 6.5% yield on investment.
Perfect. And that segues perfectly into from an investor perspective. Now, I know you've only had this deal live for, 3 days, 2 days? You've almost raised all the equity. So anyone that is interested, hopefully I can get this podcast out fast enough so they can act. But tell me about the size of the deal, the equity raise, and minimum investments, and kind of what, from an investor perspective, what are we looking at here?
The total equity raise is about 19.5 million. Myself and a few friends are together as a sponsor, putting up 4.1 million as the sponsor. That leaves about 15.4 million from third-party investors that we are looking to raise. That is currently a significant chunk of that is already committed, and we will be looking to fill that to about 15.5 million.
And you have a pref and there's a split. Tell me kind of the basic from an investor perspective.
Right. Some real estate deals have no preferred return and no priority return to investors. We think those are very favorable for the sponsor, but that is not how we structure our deals. Our deals are structured whereby we, as the developer, put up our 4.1 million alongside of our investors, and we participate pro rata with them, and we get no outsized reward or upside percentage until all the investors have made back all their money, their initial capital contribution, plus an 8% annual compounded return before we, as the developer, get any promote equity or carried interest above that. So it's a better deal than some developers do, where there is no preferred return. And I would advise your listeners that if you're investing in a real estate deal, make sure you look to make sure that there's a preferred return in the deal.
And time horizon, and what's your exit strategy? Like, what's the overall strategy?
We're guesstimating a 5-year holding period. At the end of 5 years, we might sell the building outright to a third party. We may refinance the building even as soon as 3 years out. Maybe if we get lucky with interest rates at that point, we would have surplus cash being delivered as a dividend to investors, as a so-called special dividend or partial return of capital. There are different ways that we would look to exit. We might do another online fundraise 5 years out and give investors the option to either buy into the new deal or cash out at your option. So there's a variety of exit strategies, and we do promise some sort of liquidity event approximately 5 years out. There's no assurance that that's the exact date.
All right, last question, and similar to the sponsor profile we just did. For somebody tuning in right now, all they hear is your last sentence or two. What would you want them to take away about Pinnacle Corporate Park investment opportunity, other than hurry up, because we're almost done?
If you are considering a real estate investment right now, buy deals where you can buy the bricks at a significant discount to replacement cost. You cannot do that with industrial right now. You cannot do that with apartments. Those deals are way up here in terms of pricing at, or in many cases, significantly above the full cost of replacement. So an office deal is still very attractively priced right now. And with us as an operator, you have the ability to participate in the upside by creative renovation, which will drive up occupancy and drive up revenue.
Larry Feldman, Feldman Equities, always an enormous pleasure. Thanks so much for talking about Pinnacle Corporate Park on the podcast today.
Thank you very much.
If you want more information on this deal and on all the others in this new series, plus if you want access to the latest news from the real estate crowdfunding industry, and if you want to be the first to know about some amazing proprietary industry data that we're putting together for you, subscribe now to the GowerCrowd newsletter at GowerCrowd.com. It's totally free and it is the most comprehensive source of news and information about real estate crowdfunding anywhere on the planet, all there at GowerCrowd.com. Thank you for joining me and for listening in to today's deal. This is Adam Gower wishing you well and signing off.